Thanks very much, Julia, and nothing like these post-lunch comatose slots, so thank you for thank you for coming. And also, when I first looked at the schedule and saw I was competing with Mark Cuban, I knew this was going to be a tough gig, but I think our panel is the best of the day. So,
who?
Yeah, Mark Cuban.
Cuban.
Yeah, yeah. So again, welcome. We're here to discuss unicorns, and we're on the VC version at least, and maybe that's fitting that. The time of day we want to sleep, we're thinking of fantasy animals at the moment. But the VC version, there's 1,200, at least on the latest data I've seen, 1,200 unicorns around the world. And actually half of those were created, just let this sink in 2021. Half of those 1,200 that are in existence. 2 of these are birthed a day. Pretty shocking. That is going to be obviously net down, I think, in 2023. It's also going quite global. So most of these 1,200 are US-based, but if you take a look at the league rankings, if you will, 3 of the top 4 are Chinese, 6 of the top 10 are non-US, and something like 47 countries actually can boast of having at least one of these mythical billion-dollar creatures. So it is growing substantially. And I think a lot of this is due to, obviously, the capital formation has shifted. Value creation is now happening. The industry I grew up in, where the IPO was the ultimate goal, has largely been satisfied, been replaced in the private market. So I don't expect, despite the hiccup, this to change anytime soon. So we've got a fantastic panel, 2 LPs, 2 GPs that were just introduced to kind of debate where do we go from here. And so I want to start with, I think, as we talked about in the prep, there's a couple moral imperatives that it would almost be intellectually dishonest if we didn't kind of tackle first before we talk about the future. And I want to start with valuation. Maybe I'll start on the LP side, Jeremy, with you. There was a recent debate, CAIA is always at the center of these, on private market valuations. What do we do with this, right? There was a recent debate in Institutional Investor, 2 investors I know and respect well. One said interim valuations don't matter at all. The other said this is nothing but volatility laundering. So how should we think, this has been a subject of much of the day, how should we think about the divergence, the convergence, the lag effect, the delay? Kind of help us think through the reality of private market valuations.
Well, okay. As a pure investor, I shouldn't care very much about interim valuations. I should care about dollars in, dollars out, and how long it takes me to get those dollars, right? That's true in, like, if I'm just a pure investor, don't care about cash flows, don't care about anything else. However, we all work for institutions, and institutions are clients, and clients do care about these things. I worked at the University of Chicago for 12 plus years. I'm going to the University of Illinois Foundation. We pay out based on the value of the pool of assets, and that value is determined by things like interim valuations. So you can bet that the client is going to care about that at least a little bit. I personally, as an investor, I tend to lean toward the former, that interim valuations are not, you should be aware of them, right? You should have some idea of what your portfolio is actually worth, or at least a worst case and a best case scenario, and so you can try to interpolate in between there. Saying that interim valuations don't matter at all, though, is just, you're basically trying to shut down a debate, or you're trying to stir a pot, right? And that's what people do when they're writing an Institutional Investor magazine. They're not going to nuance it. They're going to say, I'm here to stir the pot. That's what they're doing. They're trying to get you to get into an indefensible position.
Yeah. Well, maybe the other side of the table, maybe Kim, I'd love your thoughts on, again, the lag effect and the pricing. I think part of the challenge, frustration maybe I'll even say, is that there is no set of standards that determines either when, how, what methodology, what level of transparency or process each GP goes with through their pricing. So do you think that some of this could actually be a wake-up call to maybe provide some uniformity to the process so that LPs can be a little bit more aware and prepared for these board conversations that I'm sure are inevitably happening?
I could look at it a couple of different ways. But as an investor myself, you want your manager to mark your portfolio. There is ability to get marks. Christine and I, we both invest at earliest stage, pre-seed stage. And typically those types of startups raise capital every 12 to 24 months. So we are getting marks when they raise capital. And if they're not, we have to question it. Are they making so much money that they don't need to raise capital, or can they not raise capital? Or are they going out of business? That's the gray area that managers need to focus on, investors need to focus on when they're talking and doing their due diligence for managers. But at the end of the day, if you believe in your portfolio, you should take a mark in the book, because that valuation, maybe it's low today, maybe it's an opportunity to buy, but if you believe in your book and the growth in the portfolio, you just, like my mom would say, putting your head in the sand, clean your room, Kim, like just take the mark. And I just think it's important that as investors, meet with their managers, that they should stress that for them.
Your mom sounds wise.
Yes.
Yeah. Christine T., maybe I'd love your comments on this too, because Kim just alluded to this as well. Historically, the only real reason VC firms have had to price is when they're doing that fundraising. So as Kim said, when you've got this kind of all boats rising every couple years, you can kind of be largely confident you're going to get a reprice when they come back. Obviously, the vicious cycle works the other way. When things are turning over, there's no fundraising, there's little incentive to mark. So how can we kind of reconcile the cycle with the need to have some level of consistency in valuations?
Yeah.
I do think it's, oh, sorry.
Oh,
Sorry, we'll start over here with Christine T. Yeah, we've got two Christines.
I think in terms of valuations, that's definitely been, I wouldn't say a national dialogue, but maybe in our little world, a dialogue in terms of what has happened, especially in this past year. There's been very unsustainable valuations, and we see this in our portfolio. For generally, in terms of whether there's whether we're headed in the direction of having a standard for venture, either from the earliest stages to late stage, I think that remains to be seen. But I do think that what is important is that firms do have a very clear evaluation policy. LPs may have different standards in terms of what they expect. I can speak for 500 over the years. Our valuation policy has been pretty explicit in terms of taking a more conservative approach. Some of this is out of necessity because we have a large portfolio, but we typically will mark up or mark down, so we'll mark up based off of a financing that has happened. I know that discretionary markups have been pretty often used by managers because they heard a conversation about a company with an imminent raise or an imminent term sheet or LOI, and they'll go to mark that up. And I think LPs, if they're okay with that, or maybe questions from their auditors if they're okay with that, then that's that's something to consider. But I think it is important to be as conservative as possible. In the bull markets, when everyone is excited, you maybe look a little bit square, but certainly in markets like this, it looks very prudent to have done that. And I think one of the other things is, at least for us, in this year, we actually did take a discretionary mark down of our biggest holdings, the ones that are driving the fund value, not necessarily because the companies were doing poorly. In fact, many of them are sitting on very strong cash positions, doing great, but because of the public market. So I think there was the question about why is there that lag between public and private. We decided it would be prudent to take, a bit arbitrary. We took a 20-25% discount, and we still maintain that. Some firms have been more aggressive. Some have been maybe not marked down their companies. But I do think that that's maybe a hard pill to swallow. But now I think managers are realizing, yeah, it's the right thing to do, especially to have credibility with LPs who are now looking at these valuations, wondering like, why is that company marked up, or like what's the proof or the rationale. So I think there will be a lot more scrutiny.
Yeah, I think the old adage of discipline being rewarded will come true in the next 24 months, more than we've seen in at least 10 years. The other Christine, the cousin of valuation, at least in the context of this discussion, could be due diligence, right? And we've had this amazing 10-year run that I alluded to in my opening remarks in capital formation that has shifted over. In early stage investing in particular versus buyout, let's say, it's a game of numbers, right? You're talking about a batting average of, in a typical environment, kind of 100, 200, and you're a hero, right? And obviously in the late stages of a cycle, human nature is due diligence gets a little bit lazy. We get a little intellectually dishonest. We're rushed. There's a lot of FOMO. So as we think back to what happened with buyout in the GFC, could we be seeing a wake-up call with the poster children of FTX and others, where VC due diligence has a little bit more discipline and process centered on it. How are you kind of experiencing and observing that on the LP side?
Sure. Well, I mean, I think it's just part of the nature of cycles, quite frankly. And you mentioned we've just gone through a period of enormous FOMO. Tons of capital being put to work, lots and lots of competition, high valuations, and I think the market does get a little sloppy in times like that, and certainly I think people will pull back from that, be a little bit more careful going forward. But a number of people have been asking me as an LP, how do you, are you looking at due diligence differently? And I'd have to say, I'd love to hear what you think. Not really. I mean, we're still looking at the same. We're still asking the same questions, looking at the GP in the same way. Maybe you spend a little bit more time making sure that they have as much integrity as you would expect, and have a decent process. But recent events, I can't say have really changed how I do what I do.
Yeah.
Very significantly.
Yeah. Are you changing the types of questions you're asking, Jeremy?
Maybe. Remember, I'm between jobs.
Yeah. Well, so you're asking very different questions.
Exactly. No, but seriously, I think the recent events have shown that all the questions in the world don't really. You can ask all you want. You can get a really good sense of their integrity, of them having a strong process, of them having a great reputation. Right. These are the things you do in due diligence. But sometimes something's going to slip through, and there's just nothing you can do. Venture is, you said, 100, 200 batting average, right?
Yeah.
Due diligence, is not a 1,000 batting average either, right? When you're diligencing managers, stuff's going to happen that you just, right? Like Taleb would call, black swan or whatever. It's probably not quite that improbable, but you get the idea that there are things that are going to happen that you just can't necessarily prepare for.
Right.
Right.
Yeah. Do you plan to commit fraud? It's typically.
It's a tough question to ask, right?
Exactly.
I tend to get no's when I do. So, yeah.
Christine T, I want to kind of segue from fundraising to maybe a little bit of the kind of current market environment, particularly this all-important denominator effect that obviously I'm sure you're having a lot of conversations with your investors about. What I often hear is that the rationalization in a market like this creates new opportunities for access. Access, as we know, in your marketplace is really difficult if you haven't been in Fund 1 and Fund 2, especially for smaller pools, especially for those that haven't had venture books in the past. The secondary market and some of the denominator effect is perhaps opening up opportunities for some of those smaller pools that haven't been able to work with folks like you in the past, maybe high net worth. Are you starting to see different folks knock on the door, and is that changing the future of how you expect to interact with your investor base?
I think in terms of secondary buyers, there's always been a lot of interest from secondary firms over the years, probably for any early stage investor, because the cycle is very long, right? It's funds are technically 10 years, but our Fund 1 is now over 12 years old, and we see many funds from co-investors who are at 15 years, 20 years, or however long. So some investors just cannot wait that long, as much as they are excited about the upside. And secondary investors know that, especially in a market like this, there's a lot more of a liquidity demand, of course, a cash crunch. And I would say it's a very good time to be a secondary buyer, whether if it's for LP interests or late stage company interests, you're going to get a great valuation, a great discount. And people will probably, some of them will be willing to sell because just they need it. So I think it is actually a really good opportunity to be a secondary, having a vehicle for either LP interests or if you imagine like high net worth individuals or family offices, maybe more attuned to that. Institutions maybe can wait longer, and they've been through this cycle, so they. It's not something that's going to phase them. They'll continue to invest in venture. On the company side, I think definitely investors who have invested into these companies either directly or through one of the vehicles that gets you access, many of them, especially as venture has kind of in some ways opened up a bit more kind of quote retail Many of them are starting to, to find, well, I'm not sure, I need the cash, or, they haven't been through a cycle like this. I mean, we probably have seen even many of our founders have just not been through this type of cycle. So there is some panic, and there are people who are trying to sell, and I think I've observed a lot of these buyers are really just like licking their chops, eager to buy at more than 50% discount. So from that perspective, it's great to if you're looking to buy.
Yeah. Kim, how about Techstars? Are you seeing the face of the kind of typical prospective LP change a bit yet? Have you considered vehicles like aggregators or feeder funds that would open up access to a broader group?
We have been around for 15 years, and we have institutional investors, high net worth investors, all the gamut. But I would say where I'm seeing most interest is actually in the institutional endowment space, because a lot of institutions put a fair amount of capital in later stage venture. And Techstars, we are one of the largest early stage pre-seed investor. And so we are somewhat insulated from an equity market. I don't need a strong equity market today. I need one in a decade. Mm-hmm. And so when people are looking at asset allocation and looking at their potential overexposure to later stage venture, we're a bit of a complement to it. So we're seeing increased interest from institutions as opposed to our previous funding rounds.
Yeah. Christine Kelleher, I need to cite the last name here to be clear. You've had a great track record of kind of building a venture book. You did it at Georgetown. You've now done it at National Gallery of Art. Standing this up from scratch is really hard, right? It is a relationship-driven business. By definition, these are patient, locked up capital until you squeeze out the value, right? 7 to 10 years typically, maybe longer with some relationships. So, advice for those that are earlier in that journey, maybe even haven't begun that journey, and also for the GPs in the room that are obviously going to be having lots of conversations with LPs that want to build their book. What have you learned? What lessons, mistakes have you made that you can share with us?
Sure. Well, you said it. I mean, I think it's really hard. I think from my opinion is it's the hardest asset class to allocate to. I think the first lesson that I've learned is you don't have to do venture capital. And the institution really has to understand what the structure is, what the time frame is, what resources need to be allocated to build out a program successfully. So, when we started having these conversations at the National Gallery, you need to educate people that it's actually not a 10 or 11 or 12 year fund life. It's 15 or 16 or 17 or 18 years. You're not really going to know for almost a generation whether or not the decision that you've made is a good one. And again, I think the resources you have to put into sourcing and diligencing VC is significantly greater than other asset classes. So ensuring that you have buy-in from, especially your investment committee, that they're committed to, in my case, helping us get the access that we need to have a successful program is also part of the lessons learned, part of the equation, part of the buy-in before engaging in trying to build out a brand new program from scratch.
It's such a cultural challenge more than anything with your board, I assume. And I think it comes back to where we started on valuation. Like if you're overly paranoid or anxious about a quarter late, mark, perhaps you're not really thinking about 15 years. And that's trading paper, not investing, right, is effectively what you're doing. So, and I'm not trying to dismiss the importance of accurate valuation. It's just I think it is a mindset that is new and difficult.
Yeah,
right?
The flip side of that, though, is that we didn't talk about earlier. I mean, the benefit to that is, I feel the biggest risk that we have to manage is ensuring we're not making the wrong decision at exactly the wrong time. And you made a comment earlier about, the volatility or lack thereof of private investments. Well, that lack of volatility just does help our committees not necessarily make the wrong decision at the wrong time.
Yeah.
The volatility dampening is very it's attractive to someone
Right.
in our seat.
Yeah, and it's a behavioral
Yeah, exactly.
called
Yep.
exercise. So, Jeremy, how about University of Chicago? Obviously, you're going to be you're moving back towards the starting line in this process at Illinois, right? What do you expect to bring from your war stories at Chicago?
I mean, the great thing about Chicago, been doing venture and private equity for 30 plus years, had a very sophisticated board that understands venture capital and the cash flows associated with it. I think we still have some stuff on our books from the 90s, just some stubs. They're laser focused on getting us our capital soon, though. So, but as for the University of Illinois Foundation, there's relatively less venture in that portfolio, and I think there's going to be a big education process with the board to make sure that they're really committed to this as a long-term asset class investment. Is something where they can, these interim marks, while important for figuring out how much you're going to pay out to the university, really in terms of investment results, you've got to, it's almost a leap of faith. You have to just have faith that we've done our job, we've done our due diligence, we've constructed a program that is going to bring you more dollars than what we put into it, hopefully in a reasonable amount of time.
Yeah.
And so that it's going to take a lot of work. Luckily, we have a team of seasoned people from Vanderbilt and University of Chicago that already have some relationships. And as we all know, it's a relationship-driven business, right? Everybody wants that. But I think that we're going to be pretty. It's going to be pretty interesting to see how we're going to have a very wide funnel at the top, and it's going to be very narrow at the bottom because it's instead of Chicago, it's 10 billion. Illinois, it's 3 billion. And so it's necessarily we have to write fewer checks or smaller checks or both. And so it's going to be interesting to see how that takes shape as we get started.
Yeah.
So, yeah.
Yep. Well, best of luck. We'll be rooting for you in that.
I appreciate it.
Kim, let's turn towards the crystal ball, looking out as you guys are paid to do, more than a decade. And despite the disruption and the difficulty we're all feeling day to day, the reality is you're deploying capital that really is going to create value in the 2030s, right?
Yep.
There was a lot of talk this morning about things like AI and kind of this second generation blockchain once that works itself out. But at Techstars, what is the next theme to eat the world, as Andreessen once put it? What are you guys looking at? What are you most excited about?
I mean, we're going to make 1,000 investments this year across 60 countries, 15 different verticals. And we're looking for that company that's going to change the world and how we operate within that world. So AI, deep tech, I'm a crypto bull, so obviously I'm going to have to, I'm long-term crypto. But fintech, sports tech, we are going to find that unicorn. But that's not what we're looking for. We're looking for good investments that will ultimately make the world a better place, an easier place, and hopefully, and make money in that process. And so that's what Techstars is focused on. We're not trying to be the best in deep tech. We're going to find that because we're going to make enough investments. We're going to turn over as many leaves as possible to find that guy or gal that will do it and change the world for all of us.
Yep. Christine T, I read recently that there's some unicorns in India that if they were to go public might beat out the famous Alibabas, the biggest IPO ever. And I already cited 3 out of the top 4 unicorns are Chinese. I think often as Americans we're so focused on the US-based venture capital, we forget how global this has become. Are there certain geographies, sectors that you are really excited about that maybe are off the beaten track?
I love this question and this conversation because if this was happening 12 years ago, it would not even be relevant. It would be a lot of skepticism and looking at anyone investing outside of that 50-mile radius of the Bay Area is crazy. So, and I lived through that. But yes, definitely now, especially the way that the world has evolved in technology and distribution platforms and even venture capital, it is very much global. It actually looks it looks the other way, where if you're not looking at companies that are global or companies that have those global ambitions in the future, you're just missing out, leaving money on the table. For 500, we have been investing both in Silicon Valley and outside of Silicon Valley, outside of the US since 2010. Our observations and what I've seen, it's hard to pick one region. It's like picking your favorite child. But just to name a few that we've seen tremendous growth, in particular over the last many years. Southeast Asia has done quite well for us. We are very active there. We are investing both at the seed and later stages, growth stage as a multi-stage investor. We've had 3 IPOs. 2 of them have been in the US exchanges. One has been, I think, the biggest tech IPO in the Indonesian stock exchange. So there is definitely a maturation that has happened in Southeast Asia, and specifically Malaysia, Singapore, Indonesia, and then of course Vietnam is huge, Philippines. And then I think I would actually call out MENA, so the Middle East, North Africa, because there has been also very accelerated growth over the last few years in terms of both money that's going into venture, early stage venture and late stage venture, but also the companies and the deal flow. Our first investment into a MENA company was actually in Jordan, and now that has shifted where a lot of the great companies are coming from Saudi, coming from UAE, and Egypt is always full of talent. And we also see there's actually been growth in that ecosystem over the last year, whereas others, we've seen some contraction in terms of venture funding. So, one of our LPs was joking, they've never seen so many US managers coming to the region in the last few months than ever before. But I do think that there's also some of the perception that's hopefully breaking, that it's not just tourist capital, which oftentimes Silicon Valley sees investors either from MENA or other regions as. They're actually very sophisticated, have been investing in venture. They are playing the long game as well. And founders in those regions are very hungry and very talented, which we see in our own portfolio some very valuable companies changing the region.
It's exciting. And certainly there's so much kinetic energy going on in the early stage business around the world, right? Maybe I'll finish with the LPs here just on the challenge of a conversation with your board or your investment committee right now versus 2 years ago, because public equities have corrected. Yield is back on the fixed income side. I mean, remember only a year ago we were talking about what's the new 40 going to be? Fixed income is dead forever, right? That was only 9-12 months ago. And now, VC, by definition, any capital that's been raised is going to be deployed at probably much better valuations than 2 years ago, right? So how do you think about maybe an opportunistic moment, shall I say, similar to kind of GFC and dot-com bubble, to choose to allocate? This is your job, right? You've got several different opportunities. How do you determine how to prioritize that?
Ladies first.
I have to say, in an environment like this, you're of course having really active conversations about whether or not, especially your asset allocation, is the right one looking forward, especially when we feel like we're in a very different environment than we were a couple of years ago. But your asset allocation is a long-term asset allocation. So we've had those conversations kind of come back to make sure we're rebalancing, and that the managers in our book are the best managers and are taking full advantage of the opportunities that are presenting themselves today, but not making significant shifts in the way that we're allocating capital.
Last 10 seconds.
Yes.
Yes. I think long-termism, discipline, stick to your long-term plan is probably the best advice we've had all day. So we'll leave it there. Let's give our panel a round of applause.